Well, it's time for your business news. A big focus on China's ailing property sector today amid those growth concerns in the country as it accounts for a quarter of the economy. Investors are still waiting for the first half results of Country Garden, once China's largest private property developer. Country Garden is scheduled to post its financial results today. Earlier this month, the developer warned it expects to book a loss of up to $7.6 billion in the first half of this year. Unlike its peers, Country Garden is reeling from low sales and a slowing overall economy. By the end of 2022, its total liabilities neared $200 billion. More than half of its onshore bonds are set to mature before the year ends. Earlier today, it said it was planning to issue $34.4 million of new shares to pay a Hong Kong-based manufacturer. Separately, China Vanke, the country's second largest developer by sales, reported lower first-half profits. This shows how even developers with partial state support are not immune to the housing slump. A net income declined 19% to $1.4 billion. And staying on earnings, two of China's biggest banks posted their earnings today. Now, those two were barely up, with their profit margins shrinking. The first half report by the Industrial and Commercial Bank of China, also the world's largest by assets, missing estimates as well. Our net income at ICBC rising 1.2% on year to nearly $24 billion, coming in below forecast. Our net interest income fell almost 4% to about $46 billion. That missed forecasts as well. Bank of China also facing challenges, its net income edging up by just 0.8% to $16.5 billion. Net interest income up by nearly 5%, but investors likely to be concerned by the 15% on-year jump in impairment losses. Today's reports by ICBC and BOC rounding out earnings by China's top 5 banks, and here's how they have stacked up. BOC's profit gain is the smallest. Income at Bank of Communications rose the most at 4.5%, thanks largely to big trading gains. Of greater concern, shrinking net interest margins, a key gauge of profitability at all 5 banks. That's as they have been urged to trim borrowing costs and spur lending. On today's earnings, joining a flurry of reports from China's banking, property and consumer sectors. To help us unpack what all this means for the country's growth, we have Andrew Maynard, Global Head of Equities from China Renaissance Securities. Mr. Maynard, we just saw that not the best figures for ICBC and Bank of China, and concerns about profitability, which is not that surprising if you consider if they want to spur lending, they've been cutting borrowing costs, and that means what they charge in terms of when they give people loans, the difference between that and what they had to give to deposits, that narrows. And that means less profits for banks all around. So for you, would you say we need to look beyond headline figures for now to what's really happening in the Chinese economy? And if that's so, what might that be?
I think you're right. I think you'll find that the bank numbers and the financial services industry on the mainland will continue to disappoint when it comes to fundamental numbers. But in terms of the profitability, really, you agree, and we need to look through where is the fundamental problem coming from, and what is going to be the catalyst that is going to spur the growth for the economy to drive back into some level of growth, which has been lacking since the COVID strategy to lock the economy down. There was a great euphoria post that unlock announcement, and then it sort of petered out. So, you can see Beijing deploying an arsenal of measures to try to boost the economy again. But for the moment, the systemic problem with the market, and from what the market sees, is naturally not from the banking side, but on the property side.
All right. We're, of course, waiting for earnings, or rather the report out of Country Garden. But as of today, we heard earlier on, they have issued new shares to try to pay Hong Kong-based manufacturer. And these are one of many, many measures at, say, company level, county level, government level, so the China Inc. taken in its entirety. You've suggested that measures you have seen so far, are they enough? Not enough?
I think from a longer-term point of view, then obviously we still believe that the market remains a definite investment opportunity for a lot of the global money to be circulating around the Chinese economy. That being said, it's still very, very clear to most of the investors that the property market and the underlying consumption and confidence that the Chinese domestic investor is facing is really, really lacking. And what is needed to be able to break that catalyst. At the moment, from a property developer point of view, supply is way, way, way ahead of where demand is. And post the unlock and post the COVID policy, we've yet to see that confidence regain to allow some level of sustained growth to come back into the economy. So banks face issues, the financial systems have issues, yes, but the underlying problem still remains into the property market. And really, it's not an issue of price. It's more of an issue of confidence and demand to take up that excess supply that is in the market at the moment. So liquidity is the bigger issue when we really look at the problems that the market is facing. And that at the moment is keeping a lot of people on the sidelines, if not out of the Chinese market completely.
So when you say in the last 18 months that you think measures from the government have been meaningful and trackable as well, well, if they were either, then we would see a real boost to confidence. We have not seen that, have we?
I agreed, but I think you've got to play that into the reality of where we've been and where we've come from. I mean, obviously, if you look at 2 years ago, almost to this date, 2 years ago, we were euphoric highs, where investor confidence, consumer confidence, retail confidence was at its absolute maximum, and we've come all the way back. Since we've dropped all the way down, you've seen Beijing announce a lot of measures, but most of that has been rhetoric. And really, it's not been until sort of June onwards of this year where those speeches and those announcements, those statements have actually made some fundamental differences which can be tracked within the market. So from my point of view and from an investment point of view, especially from offshore, you're starting to look at Beijing in a very different light than we've seen in the recent years, where fundamental issues are being addressed and there is a clear concern that the market needs to be wooed in terms of better confidence to come in. And those measures are starting to affect that. From my belief and from what we probably see from institutional investors looking globally at the Chinese market, especially from an equity point of view, a lot more needs to be done in that respect. But I really feel that we're starting to turn a corner when it comes to the confidence, especially from the retail confidence onshore, which again is starting to show life post the unlock period that we've saw in the midst of pandemic.
Thanks. We could go on, but we've run out of time. Thanks so much for joining us this evening. Andrew Maynard, Global Head of Equities from China Renaissance Securities, speaking to us from Hong Kong.